Time for some business news now. Let's go to Scott Phillips on a Tuesday, the Chief Investment Officer at the Motley, of course. Scott, good to see you. This price of iron ore dropping from its high of about $230 a tonne a few weeks ago now to around about 180. This something to be worried about?
Peter, it's certainly something to be mindful of, and good morning. It fell 5% on Friday in overnight trade in the US and another 5% overnight our time, literally yesterday or last night. So it really is, I guess, a question of how far, how fast. I've been saying to you and others for a while now that 220, 230 was way too high. It simply wasn't sustainable. Doesn't mean it couldn't be sustained for a little bit of time while the supply constraints remained in force. But once they do get corrected, that will come down. This, of course, though, is a demand-side intervention by China's government, basically banning people and threatening them pretty significantly to say, if you are hoarding anything in the space of commodities and raw materials, we want you to get it out. We want you to start using it. They want to basically use that excess hoarding supply to drive the price down in the short term while they look around for alternatives. And that's the big watch out for Australia. China whacked us on a whole lot of tariffs on a whole lot of industries. They can't yet get to us on iron ore because there's really no other game in town. But at some point, if they manage to impact supply or alternatives, that really could be more bad news for Australia's iron ore industry and, of course, for the federal budget.
Yeah, well, and that's why Josh Frydenberg was smart to keep that conservative estimate of the price of iron ore, right?
Mm-hmm. That was fantastic. I think we said Treasury, I think it was 150 odd, I think from memory, they took the price. Yeah, absolutely. Great approach to take. It, by the way, also lowers the predicted budget surplus. So hopefully, if we end up getting more than that, hopefully if I'm wrong to the upside, then there's even better news for the federal budget. But as you say, it would have been crazy for Treasury or the Treasurer to keep that number higher than it needed to be. I think they did the right thing.
Okay, now onto the Royal Commission. Here's money laundering could still be happening at Crown, Scott.
Yeah, this is, I guess we shouldn't be super surprised to some degree, not because Crown's a horrible corporate citizen, just because casinos have always been used for money laundering. And so to imagine it might have stopped at some distant past and not been continuing despite no real significant changes from Crown or its competitors here or around the world. You know, really honestly, casinos have long been a magnet for money laundering. And as late as February, with the reports we heard yesterday, possibly in Crown's casinos, maybe in Melbourne, it is why both casinos, Star and Crown, are hurrying this cashless gambling moving forward. They're trying to bring that in as quickly as they possibly can. Of course, in part because of the Royal Commission and of course because they are being considered as to whether or not Crown is a fit and suitable, they call it a person in the legal speak, but effectively company to run gambling operations. No surprise there was money laundering. We should imagine it's still happening, by the way. That's why it's so important for us to get that cashless gambling in as quickly as possible.
Okay, now one of the buy now, pay later giants, Zip, is making these acquisitions in the Middle East and Europe. Does that make it more palatable for you as an investment at all?
Not just yet, Peter, but it's a good move. I think, you know, we talk so much about Afterpay, so much about, and we kind of treated it synonymous with buy now, pay later, right? They're almost interchangeable. Yeah. But of course there are, I mean, even on the ASX, there's another 8 or 9 buy now, pay later players who want their slice of the pie. They can't all win, of course. Not that it needs to be a winner takes all, but the good news for Zip, I think, is they are, you know, the land grab, if you like. They are rolling out buy now, pay later to markets where it's much less penetrated. They're basically, this is a race. You want to be the company that gets there first and gets the customers first. Now, the challenge with buy now, pay later is you don't have to just use one. You can have 3, 4, 5 buy now, pay later apps on your phone if you want them. So it's hard for the buy now, pay later operators to be the only provider for a retailer or a consumer. But if you get there first, if you become the known brand name, the best option, the go-to, that's really good for business. That's what Zip's trying to do with this $160 million they're spending yesterday.